In the previous two modules, we looked at net present value and payback period as project evaluation methods. Internal rate of return is the third commonly used method. The definition of the internal rate of return is that it is the rate of return on the capital invested in a project based on cash flow and taking into account the time value of money. We can contrast this with the accounting rate of return, which is the rate of return on the capital invested, but it's based on accounting profit rather than cash flow. The amount invested is based on the depreciated book value of an asset, and it doesn't take into account the time value of money. Accounting rate of return is used in some cases, but it's not commonly used in practice for capital budgeting decisions. Another way of defining the internal rate of return, which indicates how we are going to calculate it, is that it is the discount rate that would result in an NPV of 0. This is the formula that we used 2 modules ago to calculate the net present value of a project. So all we need to do is to set it equal to 0, and now instead of being given a cost of capital, we treat the cost of capital as the unknown. We'll call it the internal rate of return. We'll use the variable IRR to represent the internal rate of return, and then we have to solve for that unknown. That can be done by trial and error, using a spreadsheet, or using a financial calculator. These two methods are effectively the same thing as trial and error. That's what your spreadsheet or your financial calculator are doing. It just does it very, very quickly, and it looks like it comes up with the answer immediately. It is only possible to solve for the internal rate of return using a formula if there is only one future cash flow. Whilst it's important that you understand in theory how the internal rate of return is calculated, as was just mentioned, it's the rate of return that would give an NPV of 0. Any calculation problems in this subject on the internal rate of return will only be based on one future cash flow. We can derive an equation for the internal rate of return. Again, this derivation is shown for information purposes only. You don't need to replicate it, but it's provided for those who are interested in seeing how we get to the equations that we use. This is the equation we had on the previous slide, the net present value being set equal to 0. So this is the formula for the internal rate of return when there is only one future cash flow occurring in year N. In this equation, Cn is the future cash flow in year N, C0 is the initial outlay, N is the life of the project in years, and IRR is the internal rate of return. We should note the similarity between this formula and the formula that we derived in the topic on financial mathematics to solve for the rate of return when the present value grows to the future value over n periods.